Are you a passive investor and ever wondered what macroeconomic indicators you need to be tracking in order to make a safe investment? That's what we're going to answer today. We're going to learn how to spot stable investment opportunities. What are those real estate macroeconomics that you need to track in order to make your investing simple? All right, you are in the right place if you want to learn how to turn your active income and savings into long-term income and wealth. If maybe you've tried investing passively before, but you couldn't get comfortable making the investment, or maybe you actually invested in a deal and discovered that deal wasn't the right fit for you, or you are a seasoned investor and you simply want to sharpen your skills, you are in the right space. Your host, my name is Whitney Elkins-Hutten, Director of Investor Education here at PassiveInvesting.com. I've been investing in real estate since 2002, and I've done a myriad of things. I've done fix and flip, over $5 million in fix and flips. I've done over 40 single-family rentals, rehab projects there. I'm also a partner in over $800 million of real estate, including residential and commercial real estate. And I've authored my journey in my book, Money for Tomorrow: How to Build and Protect Generational Wealth. But all of this is to serve one goal, which is how can I spend more time with my crazy crew pictured here and travel and spend time in nature? That's my jam. That's what I love doing. Some people love traveling the world, extravagant vacations. For me, give me a nice high alpine leak, nobody around, and I'm in bliss. But I want to show you how to do that too. And again, you can check out my journey in the book Money for Tomorrow, published with Bigger Pockets. You can also find that on Amazon. But all of this, my entire real estate portfolio, the active holdings, the limited partner holdings, it's in service of one goal, which how can I have 100% control and choice on how I spend my time? And I want to show you how to do the same. And so really what I do here in the passive investing master classes and boot camps is how to help you develop the skills to become a seasoned investor and scale a portfolio of your own. Now, we can help you do that here at PassiveInvesting.com, whether it's through our equity assets or even our debt cash flow assets. We can help you scale the portfolio that's going to help achieve your investing needs. So make sure to join the Passive Investing Club. There, you can hop on a one-on-one call with me. We can discuss everything about your passive investing goals. You'll get access to our vetted opportunities as well as additional comprehensive investor resources. So make sure to visit passiveinvestingwithwhitney.com or scan the QR code on your screen. Now, we are going to dive in today into real estate economics. So if you are expecting a presentation where somebody's showing you a ton of flashy, financial reserve charts, FRED charts, and really going to make you an economist, that is not it. My goal today is to help you create a framework for yourself so you understand how markets move, the different market cycles move, how different credit cycles move, and then also what are those indicators you should be looking at and keeping in the back of your head, maybe even tracking on a quarterly basis to understand, is this a good market for me to invest in? And what should I be investing in? Now, we will talk some numbers. Everything that we always talk about here on the podcast, on the masterclass, and the boot camps is education. So make sure you take everything back to your investing team before making an investment decision. All right, so it is August 2025. Everybody's been looking at headlines for the past 2.5 years, going, wow, the market it crashes imminent. We are going into a recession. And yes, some parts of the market have had, recessive bubbles. Things have been challenging, interest rates have been high, but it doesn't mean that there's no path for investing. And I actually like educating my investors that I coach. Don't read the headlines. Let's actually learn about the fundamentals and you learn to track the high level fundamentals that will allow you to match what you should be investing in with your plan, your actual goals and your risk tolerance, so you know what to do in the different parts of the market cycle. Because you get this, headlines are all about fear and driving that fear even further. It's all about click the click. How many clicks can we get? So it's very emotional. right? So again, we don't want to predict the economy. That's not our goal. We want to understand what the economy is doing and what is the strategy that matches for our plan and matches where we are in the economic cycle. So the first thing that we need to understand as an investor is that the market does cycle. Okay, we've got two cycles going on simultaneously. We got the market cycle and the credit cycle. There is heavy overlap between the two, but we're going to tease it apart a little further. So here's our picture of the market cycle. We've got our phase one, which is generally recovery. That means we're coming out of a recession. We got decline in vacancies, no new construction yet because lending's not quite back. Then we head into expansion. Lending's back in full force. We got declining vacancy, new cranes in the air. Then we have phase three, which is hypersupply. We have increased vacancy, new construction happening still, but supply demand starting to get a little bit out of balance. All right, then we start heading into a recession. This is where our vacancy, our deliverables continue to increase. A vacancy pushes higher. Things are being completed, but it's kind of it feels like a race to the bottom on rents. Now that is one part of the cycle. Okay, it can happen in the general, broader stock market cycle. It can happen in the real estate cycle. It can happen in multifamily, self-storage, hotels, office. Even all these like different asset classes cycle a little bit differently from each other. All right. So there are different ways to invest that matches up with each part of the market cycle, but we also have to understand the credit cycle and what are those leading indicators that we need to be paying attention to. So again, here's like a little, where are we today? I want to make sure to help you understand. Before you start reacting to the headlines, you are a savvy investor. So we want to understand where are we in a particular market cycle. Now, markets, not only do they cycle for asset classes, they also cycle in different regions at different times. All right. So one could argue that the general consensus across the United States, especially in multifamily, we're still in a bit of a recession. We still have a lot of deliverables coming online. Vacancies are really high. Rents are maybe stabilizing and in some areas still declining a little bit, but there's no new development. So what we have to do is be patient and wait for absorption. All right. So then we're going to go into, if we've been in the recession part of the cycle, then we'll go to the other side of the screen into recovery, right? Vacancies continue to decline, rents are going to stabilize and then start increasing. There's very limited construction here because our credit cycle isn't back and running yet. But then we start growing. We go through the expansion over here, falling vacancies, accelerated rent growth, increased development. But then we start hitting hyper supply, risk of vacancies, slowing rent growth, excessive construction. Here's the thing. All of this creates a huge cycle. I want you to understand as an investor, deals don't disappear in different parts of the market cycle. Okay. The winner of the deal shifts. So that's very important. All right. So we need to understand how the market cycles. We got this big ebb and flow going on here, as we see on the right-hand side of the screen. But now we have the availability of money. Okay. What's happening in the credit cycle? Now, pretty tightly, the credit cycle generally works in lockstep with the market cycle most of the time. And we're going to explore the 5 different times that it doesn't. But on a whole, it's pretty safe to say as the market is expanding, okay, credit becomes more and more available. Okay, lending's happening, new construction is happening, cranes are going in the air. But when we hit that hyper supply, and rents start declining, projects aren't able to sell as fast, timelines start extending, markets start getting really overcrowded, less credit becomes available. So we see kind of a contractive pullback from the banks. It doesn't mean there's not any money or credit in the market. Remember, the winner shifts. So the banks are winning on this expansion. The individual investor, smaller investor, the private lender starts winning in these 2 parts of the cycle. Okay, so as the bank credit gets sucked out, Loans get harder and harder to secure by your, government-sponsored entities like Fannie Mae, Freddie Mac, maybe even some large REITs and insurance companies. We start seeing the private lending partner being able to step in with their lending solutions. Okay. And then eventually we hit bottom, the tides start turning again, and then the credit starts loosening a little bit as we start seeing those market indicators turn more positive. So when I think everybody wants to know, what are those 5 indicators for us to track as a passive investor to know that the market is turning, the tides are turning, that it's maybe safe to come off the sidelines for an equity-like investment? Well, let's take a look here. Okay, so here are some major credit signals that actually matter. All right, a lot of people have been paying attention to the tension between the White House and the Federal Reserve. Is Jerome Powell going to lower interest rates? And finally, the markets are going to recover. But here's the thing. Even if the Fed cuts mortgage rates, it does, or excuse me, the Fed fund rate, it does not mean mortgage rates are actually going to fall. Why is that? It's because the 10-year Treasury, the 10-year yield, is actually a stronger indicator of what will happen to mortgage rates than the Fed's funds rate. All right, so that's the indicator number 1 that we should be tracking. What's happening to the 10-year Treasury? All right, so we want to make sure that, so the 10-year Treasury is actually the benchmark for long-term debt that influences mortgage rates and cap rates. So watch for general trends as opposed to day-to-day fluctuation. I would check on this and maybe plot it once a month, once a quarter, check to see what's happening here. Another indicator to pay attention to, as opposed to those scary headlines, is what's happening with the SOFR. Okay, essentially that's a kind of a red flag of what's happening with credit either expanding or tightening. Okay, the SOFR index measures lending appetite and availability. When banks pull back, private capital often steps in, but with different terms that are more favorable for them. That's when the private lender really, really shines. We also want to pay attention to what's happening with inflation. Okay, so inflation, the CPI, the PPI, okay, inflation affects both rent growth potential and operating cost and structure. So what does that mean? Well, even if you had a equity deal, say like a value add multifamily deal come online, that if inflation's high, the person who is either going to be renting from you they're not going to be able to pay as much for that rent because their dollar is valued less. Or if you're doing value add, your construction costs are going to be higher. So it still may not make sense. What we want to look for is the spread between the two. Do we still have a healthy spread between rent growth and that inflation? Okay, we want to see rent growth outpace inflation. All right. Now we're kind of getting into a little bit more of like the local, kind of like more touchy-feely measures to take a look at. But we want to look at job and population growth. This tends to be more local dependent, right? So if you're reading national headlines about job growth, that isn't going to give you an overall macroeconomic indicator if it's safe to invest in North Carolina, right? We want to get more specific here. So what are the primary demand drivers for real estate in that area? Okay, so job and population growth are going to drive demand for real estate. Okay, we want to make sure that we're not just tracking overall total of job growth and population growth, but the migration patterns between markets. So is North Carolina growing? If so, from where? Okay, where is their job growth coming from? Where is their population growth coming from? All right, the last indicator to take a look at here is consumer confidence, okay? Because consumer confidence impacts savings. How much money do people have in the bank to pay? Okay, this is one of the leading indicators for a recession probability. So we want to look for sudden changes in consumer behavior. Because if all of a sudden consumer confidence drops and savings in the bank starts skyrocketing, it tells you the average person doesn't really have faith of what's happening in their particular market. So what I like doing is tracking, okay, taking a look at these only 5 indicators. I totally can go nuts and look at inverted yield curves and all different metrics that I've heard that you should track. But these are the main 5 that I like looking at to tell me whether that market is a good market for me to go into and invest. So some of these are more macroeconomic level, high level. Some of these are more macroeconomic on the local level. All right. So how do we apply this? Okay, now that we understand our 2 cycles, our market cycles, our credit cycles, the 5 things that I suggest as a limited partner that you get familiar with and track as opposed to reading all the doomsday headlines. Okay, how do you start applying this to your investment philosophy? Well, again, it really depends on your goals because people, I mean, investors, you can make money in any one of those market cycles. It just depends on what your goals are, your risk tolerance you're willing to take, and who the winners are and who the losers are going to be in that market cycle. So, in the expansion phase, whenever credit is flowing, we've got vacancy decreasing, we've got new construction happening. These are great times for equity growth plays, value add development. When we're in the later parts of the market cycle, okay, credit starts pulling back and tightening. The banks start leaving and the private investor money can step in replace of the bank money. Those later cycles into hypersupply, into early recession, those are where the debt funds really shine, preferred equity really shines, and stabilized income assets really shine. Does it mean you can't do an equity deal? No. I'm going to show you how you could still do an equity deal here in a moment. And then when you get into the recessive part, how do you know the market's hit bottom? Nobody knows, right? But if you're tracking those indicators, you're going to have a pretty good idea of like how things are peaking and then starting to come down. And then when they start to kind of come out of the trough a little bit, that bottom part, those are really great times to pick up distressed acquisition, but more importantly, protect your capital stack. So this is where our buddy Warren Buffett's sage advice, rule number 1 of investing, don't lose money. Rule number 2, see rule number 1. This is where it really comes into play because it's like catching a falling knife, right? So, but again, you can make any money in any parts of the market cycle. All right. So, what are those questions to ask? Okay, especially if you're looking at an equity deal. All right. Or even like debt deals, but I kind of engineered the slide more towards equity deals because I know a lot of limited partners are asking me right now, Whitney, is it safe to go in an equity deal? For me, I'm still kind of, waiting and seeing, preserving my capital, waiting for the right time to pounce. I'm still taking advantage of those late cycle fixed income asset type investments. But what would I ask an operator to understand if they are looking at the same thing I'm looking at? Well, for one, market awareness. If you're looking at a deal, I would specifically ask the operator, what specific market signals are you tracking for this asset class in this location? Are they tracking the big 5? Hopefully they are. Underwriting adjustments. How has your underwriting methodology evolved to account for today's economic environment? So many operators have taken their lumps over the past 2.5 years. I hope people have adjusted their methodology. They should be adjusting their methodology. Okay, you want to understand what those adjustments are. Contingency planning, same thing. What happens to returns if the market shifts faster than expected? Okay, walk me through your stress test on this particular equity deal and help me understand how you're protecting the downside. Now, for those of you here that are kind of going, ooh, I don't know what a stress test is. What does that really mean? Well, stress test means you're looking at your ideal situation, but what happens if we have interest rates go up? Does the deal still work? What if the break-even occupancy drops lower than expected? Say like, the operator penciled out a 60% break-even occupancy. What if we go down to 55? What happens to the deal? Stress tests will also look at reserves, adequate for economic downturns, extended downturns. Okay, so Operators should be looking at, making sure that they have not only enough reserves to last for the business plan, but just look a little bit more in case the timeline extends. What are those assumptions that the operator is making about rent growth? And then, it's always worthwhile to ask, how liquid is your capital if an early exit is needed? Now, here's the thing, equity deals are often very illiquid. All right, so expect the operator to tell you your capital is locked up in an equity deal. You can't pull it out. We're partners. All right, so you want to make sure that you're looking at these stress test questions, okay? Because what happens if cycles shift quickly? Your job as an investor is to understand what happens whenever we go through recovery, growth, hypersupply, and recession. Right? Then you want to make sure that you understand the 5 different key indicators that will help you understand the credit cycle, okay, and how that will trend, and the national macroeconomics and local macroeconomics. Also, make sure that once you looked at those 2 key pieces, that you are picking the right strategy for your goals and risk tolerance. Right? Make sure you tailor your approach. And then the last step, make sure that you're actually asking those questions, especially going into an equity deal in a recovery or recessive part of the market cycle, that you're asking those stress test questions for every deal in every part of the market cycle. All right. I just want to thank you for joining me today. If you're interested in learning how to unlock your investing potential, join our passive investing club. Jump on a one-on-one call with me. We'll discuss your investing goals, discuss our open opportunities to help you meet those goals, and connect you with additional resources to accelerate your growth. Visit passiveinvestingwithwhitney.com.